Hello. All right, so we'll start out with our traditional market monitor. And so this is, keep in mind, this is all the way through October. So market monitor now has updated through October. So let's just go through these and then we'll hit some other things. But here's median sales price. So it's very interesting. We're kind of right stuck at 400, which is not a bad place to be, but we're the last 1, 2, 3, 4 months, we're right around 400. Which is where we were in April, right? So April, we we're at 400. We jumped these 2 months right here, May and June, way up to 425, 420. So again, we're 9.6% higher than a year ago. But this number has been decreasing every month that we do this. And when I look back, so here we are, we're at 400. If we look at last October, we were 365. November, we were 365. Well, I certainly think we're going to be above 365 in November. December of last year, we jumped to 385. So do we drop, again, the seasonality, if you go back to 2019, you do have the seasonality in median sales price too. So it tends to go down towards the end of the year. And if you look at what happened, in 19, I mean, it can reduce. I mean, you look in the 2-month, 3-month period, it reduced $15,000. Do we go below 385 December? I don't think so. I don't think that's the month where things will flip to negative. And then look at the big drop we had to January. We're at 360. Well, we're certainly going to be above 360 in January of 2023. So I still feel like your risk at being a negative number is probably right in that spring window in here, April, May, June. I would fully expect May and June to be below 425 and 420. But this is where, you got to watch that national media and the local media. When they look at numbers, they always look year over year. So I expect it to flip negative at some point, and certainly in May and June, I expect it next year to be negative. But again, look at how flat we've been the last few months. So do we kind of finish the year going sideways at 400? Maybe, maybe we end up there. But anyway, just interesting perspective on median price and where we're at. Price per square foot, again, very flat since April. All right, look at that just trend. And it was obviously a strong upward trend coming out of into 2020, 2021. And since April, it's been extremely flat. So that's just a little bit different perspective of prices going flat in here. Median, so here we go. So percentage of original price. So remember, this isn't when you've done 3 price changes and now you're under contract, and then what that percentage is. This is from when you originally listed it. So we were peaking out over 100% in the summer of 2021. The summer of 2022. And remember, we always have, if we go back to 2019 as the last kind of, if you want to lack a better term, normal year, we start low and we peak out in the spring and summer. And you can see the variation is, maybe a little over 1%, and then we come back down. So this is very traditional seasonality right in here. This was obviously very, the high demand, low supply really jumped this. I mean, look, we go from, this is average, remember. So we went from 97 to over 100, back down to 99, over 100. But look at this drop off from May. So May, the average was 101.2, and October was 96.6. So that's almost, we're getting close to a 5% drop. So basically that means from original list price, sellers have been overpricing by 5%. And again, October means probably, what do you want to say, August, September contracts. So we haven't seen the September, October contract period writing with 7% interest rates, right? So I expect this number to keep decreasing because look at your hot sheet, look at all the price changes, right? Those price changes are going to affect that average of original list, and the median, we were at 100 from February of 2021 all the way to August of 2022. So, I mean, there's a good kind of 18-month window. We were the median price. So half the houses were selling full price or higher. Well, in September and October, obviously we lost that. So we're at 98.3, but keep in mind, traditionally, we're in the 97 to 98% range as an average. So, we're going back down. Maybe we're going to overshoot it because remember, I think some sellers might be still living back in here. And look at all those price changes. So I believe this median and the average are going to continue to drop. If you're seeing price changes down, that definitely means the average and median are going to continue to drop. And if you look at some of these bigger builders, I mean, I look at D.R. Horton. I mean, I saw some price change the other days that were 12 and 14%. And so, from the original list, that's going to have a huge impact on the average, especially. So I expect these to keep dropping, especially through the winter and early into next year. Days on market. So we're kind of climbing. We were at 3 for the spring, summer. This is median. Now we're up to 11. So remember, median means half the houses listed are going to sell in 11 days or less. And historically, that's still really fast because if you go back to 2019, we were in that 20 to 30 range. And, the seasonality also shows up in median days on the market because it's the opposite of the other curves. Your high median days on the market in the off season and low in the spring and summer. So you can see in 2019, we varied in the off season in that 30 to 35 range and getting as quick as maybe 20 days on the market. So 11 is still faster than anything back here. I still expect this to continue up because remember, this October number 11, those are probably the August, September contracts. So once we get to October, November contracts, this number will probably be going higher. So median is 11, average is 26. Now again, the normal average was kind of 2 months, right? So on average, it was taking 2 months to get a contract. So, on average, 2 weeks is not normal. 2 months is normal. I expect this number to continue to go up. We're going to return to what the normal market was. And even though it feels abnormal now, it's still way faster than the normal market. So, you have to put everything in perspective. The market has changed from where we were here, but it still doesn't mean that we're in a bad market. We're just returning to a normal market. But this number will continue to go up. Months of supply, we're drifting higher at this point, 1.9 months. But again, here's back to 2019, we're at 4.3 months. So we still have some time to go. And again, we will return to this level at some point. It's just going to take a little time to get there as we build up the supply. And if the demand stays lower, this number will continue to go higher.
Anton?
Yeah.
Take a look at the new construction versus previously owned.
Yeah, so if you look at the new construction,
undo.
so 1.9 overall for everything. New construction, we're at 3.1, right? So 3.1 months for new construction. And you can see that has surpassed surpassed last year's pace. And we're getting awfully close. I mean, it's traditionally a little bit higher than the resales, but around 4.5 months, we're getting there very quickly. And you also have to keep in mind, this is October numbers. It's probably already higher today.
Right.
So if we look, new construction is 3.1, previously owned,
It's about a month.
it's 1.6, right? So what does that mean? That means resales are being absorbed twice as fast as the new construction. So also keep in mind, these builders probably built a lot of inventory in some places that, they expected the demand to still stay high enough to absorb it. And when it's not, when it's not being absorbed, they have some inventory sitting there that they need to get off their books. So that's what's showing is 3.1. This, they will control at some point, right? They're not going to continue to build, as fast as they possibly can, not knowing that there's a buyer there. So at this point, at some level up in here, they're going to control what is out there. I also think part of this jump is because of the increase in inventory from probably canceled contracts, right? A lot of these contracts were probably written where the interest rate the buyer thought they were going to get might have been 3%, and they wake up today and it's 7%. And it might not even be a matter of they don't want to do it. Maybe they can't do it because they're not qualified. So I think part of this jump is because of houses they were building for a buyer that the buyer ended up not being able to afford the house because of the rates. So thanks, Sean, for kind of diverting us that direction. But keep in mind, the previously owned is twice as fast as the new construction. You can see the difference right there. So we go back to all construction. So we're about 1.9 months, which again, historically, and I want to put it in perspective where we're at right now. 1.9 months is lower than we were pre-recession. So we are still much faster absorption than we were even pre-recession. Let's go back to 3 years. So homes for sale. So we can look at it in the same way. So this is the seasonality that we normally would see. So if we go back to 2019, you can see that increase in inventory and then going into the winter, the decrease, right? So that is a fairly typical Charleston market. We lost a lot of the seasonality in here, but then it started to return last year. You can see a little bit of the seasonality here, the drop off, seasonality increase here, but it's interesting. So if you look at July, August, September, October, drifting higher, but not jumping higher, right? So I call that more as we're drifting higher on inventory, but keep in mind, once you get to the second half of the year, so if you look at the peak in 2019 was May, and we kind of drifted lower the rest of the year with a big drop off in November, December. So we should be past our peak and going down at this point if this was a normal seasonality, but we're drifting higher. So, what do I take that to mean? I think we'll basically be drifting the next couple months, but then we could see another increase that we traditionally would see the beginning of the year. So I think we're kind of forming a bottom here that we're not going to go below 3,000 again. And we should, in the beginning of the year, we should start to go higher. A lot of factors are the interest rates because the supply, a lot of it's being controlled right now by the low interest rates that everybody owns a house in. It's very, the sellers need a defining reason more than they just want another house because they're leaving a really low rate for a currently high rate. So it's hard to motivate some sellers if they're locked in long term on a really low rate and not having a defining reason in their life to move. So that's why we're seeing some of the sideways movement. But again, keep in mind, we should be going down on inventory this time of year, not drifting higher. If we do the same thing that Sean mentioned, so we have 3,200 total, look at the new construction. So new construction, we have 1,100, right? So roughly a third of the inventory is new, but the new has jumped 50% in the past year, but look at that increase off the bottom. So we almost have triple the new homes, and look at where we're at from historically in 2019. So in 2019 in the summer, we were about 1,300 homes, we're 1,100. New construction. So that is awfully close to where we were in 2019. So it puts in perspective, the builders have a lot of inventory sitting out there relative to where we've been the last couple of years. Again, I think they will control it at some point. A lot of what you see out there is stuff that they already had planned, already had in motion. If the supply chain fixes itself and they can build houses in a reasonable time frame again, they'll do it more of on a controlled base. And again, a lot of these could be canceled contracts that came back on the market at the same time. So if we look, so here's the new construction, 1,100, previously owned, 2,100. But what's interesting, look at the previously owned. We've actually been mostly sideways, but even like a little bit lower. So it's hard to motivate those people that already own a home to sell it. That's what this sign is. So where has the increase in inventory come in the past 2 to 3 months, right? We've been going kind of since July, we've gone from 2116 to 2111. So let's just call it sideways in the last 4 months. Look at the new construction. Look at the
Thank you.
last 4 months. We've gone up a couple hundred. So this drift higher is really due to the new construction hitting the market. So let's go back to all construction. So 3,200, we were at 6,400. We're right about half of where we were prior to any sort of COVID, right? So we're about 50% of the inventory. So, you know, again, yeah, there's a lot of homes on the market compared to March, but there's still half compared to 2019. So just, you know, keep that in perspective for everybody. Closed sales. So closed sales from, and again, this is year over year. So October 2022, we're down 32% in closed sales from October of 2021. So we had 1,357. Last October, we were at 2,000. Right? So that's 32% lower. Well, let's go back and look at 2019. We had 1,386 closings in 2019 in October. We had 1,357 today. So we're looking a lot like this chart here. Doesn't it look a lot like this chart here, 2019? So essentially we have gone back to where we were in 2019 in closed sales. Again, new construction, it's kind of, you see a little bit of seasonality there, but you know, the resales are off even a little bit more than the new construction. But again, the peaks and valleys look like 2019. New listings. So this is the one chart that I tell people, it's like, it's really hard to tell there was any sort of pandemic because everything looks like a normal kind of seasonality of new listings. Now, what's interesting is we're off 10% this year compared to last year. So 1820 this year, last October, we were 2029. If we go back to 2019, we're at 2100. So our downward, you know, and I don't know if it'll show if I do this, but you can see if we do a rolling 12 months, we're kind of falling off the cliff on new listings. So when you do a rolling 12 months, that kind of gets rid of it, any seasonality. So this is the best way to eliminate seasonality if you're looking at data. And you can see there was a slow increase in listings in 2019. And then here's the pandemic, the start of it, right? And then we started going higher through the year. And we peaked out actually the summer of 2021 is where our peak was. And then we've been drifting lower. And then since June, we've fallen off the cliff. Right? And why is that? And again, this is a rolling 12 months. So it's getting rid of seasonality. My belief is the reason why, when did interest rates really start to jump?
June.
I would say right about where my cursor is. Right? So there's some demotivation of sellers to sell their house if they had a really low rate. And that's what we're feeling right here. So if we go back and look at the 12 months, so we listed 1820, and again, that's less than we were back in 2019. So we're on a decreasing trend on new listings. And in order to have a transaction, you got to have a seller, right? So, you know, this is something to keep in mind, is that we're fighting for less listings because there's less motivation on the seller side. So pending sales. So pending sales are off 31%, right? So pretty close to the closed sales, you know, it's off 31%. So we had 1,319 closed sales in October. If we go back to October of 2019, we have 1,571. So we're actually lower than October of 2019. Now, I wanted to go back in time. So October, let me see here. So we had 1,221 in 15, 1170 and 16, 17, we were at 1474. So closed sales, we haven't been this low in October since 16. So, and this is, again, different than prices. This is the transaction count that's been hit the hardest, way harder than prices, right? So the transaction count is drifting backwards in time simply because there's not enough motivated. So think about it. We have not been in a period recently where you've had demotivation from sellers and buyers at the same time. So we're trying to find those motivated buyers with a defining reason and that can afford it. And you're trying to find those motivated sellers that have a defining reason, are willing to sell their house, especially if they have, if they have a low rate. So this is the chart to kind of watch what's going to come forward, because, if we're down to 1,319, and I wanted to zoom in again. So you can see the seasonality in the pending sales, right? So we drift downward typically from October to December. And if I look at, October as an example, if we have 1,571 in October of 2019, and we go down to 1,072, where we're going to be at this year, I mean, we could be at 1,000. We could be there from, a December. And again, 2019, we're at 1,072. Is it going to look like that? I wouldn't be surprised. And then we bounce off of that, right? And we will bounce higher once we get to the spring. So what you have to work on the next 2 months is you've got the people who are going to do something in this spring window, right? And it ramps up so quickly. Right? It is a quick ramp up. So what you need to be working on the next 2 months is basically making sure you're in front of those people that when the calendar flips, they're going to start to do something. And people will, even at high interest rates. We will have a seasonality next year again. There will be an increase in the, beginning of the year, into the spring, into the summer. But what you have to be working on right now is getting in front of those people that are going to do something. So I know it's hard to not get frustrated, but don't get frustrated if they're not listing before Thanksgiving and Christmas. Just stay on them, keep in front of them, and make sure when they're ready to do something, you're there. Pending sales. So pending sales were off 24%. So we're 762 million. So off 24%. And if we go back in time though, so 762, the highest we were in 2019 was 718 million. So even our low month here is still higher than 2019. So, again, 24% is simply because we don't have enough transaction count. If your closed sales, let's go back to closed sales. If your closed sales are off 32% and your dollar volume's off 24%, all that means is basically your price went higher because you're closing a lot less properties, but you're not losing as much volume. So again, we don't control, this number as a whole. All we can do is individually, get our share of this. But it is going to blow, and it's going to be a challenge to hit these 1.2, almost one. There's 1.23 billion. That was the high month in June of 2021. It's going to be hard to get over $1 billion next year. I think your peak months are going to look more, probably capping out somewhere in here. Maybe it'll look like 2020, but I don't think we're going to cap out in this type of level, strictly not price related, more from a transaction count related problem. Shows to pending. So again, we're down to, our median is 8. I mean, we were doing 13 showings at the beginning of the year. Now we're down to 8 before you go under contract. So, I mean, this is a good tool to use with your sellers. Is if you've had 12 showings, well, you're above the median and you haven't sold, that's the market telling you you're overpriced. Who cares what the comps say? That's the market saying you're overpriced. The average. So the average, we've been going up the last few months. So we're up to 13 showings to pending. What does that mean? Why are we going up here? I think the buyers are becoming more picky, right? They're looking at more houses. They're like doing second showings. They're taking their time and making a decision. So I think this increase you're seeing is because the buyers are becoming more selective and considering more houses and looking at more houses. And yes, there are more houses for sale. Showings per listing, we're about 5.5. So a little a little over a showing a week is, what your listings are averaging. 1 to 2 showings a week is probably the range that most showings are, most listings are in right now. Does anybody have any questions or comments on the overall kind of market numbers that we looked at? Because I just wanted to go through and show to you too, like, depending on what area you're working, I'm just going to go pick, I went on a listing appointment downtown this week, and I wanted to show you how different the markets can look. So we're just picking MLS area 51, so inside the crosstown. And so when you look at median sales price, it's up 44%. Is every house south of the crosstown up 44% in the past year? No. Right? So keep in mind, when you're in a market that doesn't have a lot of transactions, don't let these numbers, the overall numbers, that's a lot of data. But when you narrow it down too much, it's not true that every house downtown Charleston went up 44% over the past year. That's just a lack of a lot of transactions. So here's your median price per square foot. Again, it looks great. It's up 18.5%. Now, what's interesting is percent of original list price. So here's the median is 97.1. So not as high as the market as a whole. The average is 95%. So keep in mind, downtown is a little bit more negotiable than the market as a whole. Everything's kind of, trending lower, but, again, not as many data points. Days on market, and let's get rid of some of this seasonality. Again, not much data, but we've worked our way. So even 2021, right? So 2019, we were down to 74 days on the market. The pandemic happens, we go up to 124 days, right? So isn't that an odd set of data? We went up, and now we've drifted all the way down on average on a 12 months to 55. But 55 is still much higher than the market as a whole. And here's the median is down to 10. So again, if you look at monthly, if you don't have many sales, it can jump all over the place. So be careful when you have small data points, but downtown's about 25 days on the market on median right now. Months of supply, it's still pretty low. We're about 2.5 months of supply. So think about it, in 2019, we were at 17 months of supply south of the crosstown. And I want to put that in perspective, everybody. In the recession, Charleston as a whole was at 17 months. So 2019 absorption was recession-like numbers for the market as a whole. And then we obviously improved all the way down, got down to 1.5 months of inventory in March, drifting higher, but 2.5 is still significantly better than we were in 2019. But by a huge factor. So again, here's the downtown homes for sale. So in 2019, inside the crosstown, we had 400, almost 500 homes for sale. And then we drifted all the way down to the spring. We got down to about 89. And then we've been up, but we're kind of going sideways, like what we're seeing in the market. So we have about 115 for sale, which is significantly lower than 2019, even 2020. So again, downtown does not have much inventory compared to what it had even just 2 years ago. Closed sales. Now, this is an interesting chart here because, we're plotting along, we're running, depending on the month, between 20 and 40 sales. And then it took us till 2021 really to jump, and we were hitting in the 80s for some months. That's why the inventory was being absorbed. We came back down in the winter, jumped back up this spring, and then again have fallen down to 21 in October. Now, I also want to put this in perspective. 21 in October, I think I had to go back and look. The last October we only had 21 or less was 2009. So look at the jump downtown. Look at the variation of that market downtown. And again, I'd say the downtown market has much more, seasonality than even Charleston as a whole. And you can see it back in here pre-recession. In the winter months, we're going from 20 sales. In the peak months, we're going to 80, right? Jumping all over the place. And then what are we doing now? About the same thing, right? We're going from, 15, 20 sales up to 80, down to 30, up to 75, down to 21. So this is showing you even more so downtown than other areas. There is a vast difference in the seasonality downtown. So it'll be interesting to watch this once we go into spring and summer. Are we going to see 80 sales and 75 sales next spring, summer? I doubt it. It's going to go back to, look at 2019. We were ranging from 20 to 40. And again, if we only have 115 for sale, it's hard to sell 80 in a month. So what I expect downtown to look like is go back to here, and we're going to fall in that range again. Because keep in mind, once you went back further, we had 500 homes for sale. It's a lot easier to sell 43 homes in a month when you have 500 for sale than it is when you have 115 for sale. So new listings, pretty flat, but, still trending. If you look at that, trending lower. Pending sales, again, the spring, summer rush, trending lower. Dollar volume, off 46% from last year. But again, when you only have 21 sales, that can make a huge difference in, total dollar volume, but still about where we were in 2019. Showings pending, 12, and then showings per listing, 5.6. So again, you can look at the market as a whole and look at all the areas, but if you're going on a listing appointment somewhere, just keep in mind those numbers might be dramatically different depending on what area you're in. Look at the new construction, right? There's not that much new construction downtown, but you could be going on listing appointments that are neighborhoods that you're competing with builders and maybe multiple builders. So you got to see what those builders, at the same time, when you're going on those appointments, what are those builders offering as incentives? Like how much inventory do they have sitting there? And again, we're getting towards the end of not their fiscal year. Most builders' fiscal years are September 30th, but we're getting towards the end of the calendar year. They're going to put some incentives for their houses that are sitting there to get them closed and off the books by December 31st. And you're going to go through that cycle every quarter until they deplete their inventory down.
Anton? Oh,
yep.
sorry. No,
Go ahead.
finish. Go ahead.
No, you're fine.
So when you're looking at, say, whether it's downtown Lower Peninsula or close in Mount Pleasant or James Island, does it make sense to look at it on a rolling 3 months? Because that at least gives you more data and shows a trend a little bit more, especially with the change in interest rates since June.
Yeah, and I think if we go back, let's go back to our example of
Peninsula.
go back to Area 51 again. I'll get rid of the new construction. So if we zoom in, let's go back 5 years. So if you look at, if you look at sales price, again, the 44% is not accurate. Let's look at rolling 12 months. So rolling 12 months gets rid of that seasonality and gets you a lot more data points in there. And you can see that higher trend coming out of, and again, it's so interesting that it was down all the way until spring of 2021. So I feel like there's a time lag downtown, because when they started with 500 listings, they were when you have 17 months of inventory, your prices have a hard time going up until you get down to a more reasonable number. And I think it's that time lag, because if you look at this, when we had 17 months of inventory, so here's the months of supply, right? And this is rolling 12 months, but your prices have a really hard time going up when you have 14 months of inventory, right? And then when so look at the pattern here. When you went from here and the inventory, the months of supply dropped, what did the prices do? Boom, they went up. So I feel like downtown went through this time lag of it had to clear some of the inventory out to experience this upward price movement. And I think that there's like, it's almost a 12-month time lag of for downtown south of the crosstown. So I think if you group the 12 months, it'll give you a better perspective without the wild gyrations of not having many data points. So you can tell, go ahead.
I was wondering about 3 months, since that was the distinct change in the
Yeah,
market.
so
Is
the
that-
only problem I have with 3 months, it doesn't really get rid of the seasonality,
Right,
right? So 3 months still can kind of be pocketed. Oh, that was the summer, or that was the fall, or the winter. When you go back 12 months, it kind of eliminates any sort of seasonality.
Right.
See that trend. And you can see that decrease in inventory, how quick it was all of last year. And then you can see it slowing down, right? It's starting to bottom, reach that bottom valley here. And so these are long-term trends, right? And that downward movement, we're forming a bottom. And I'm not saying it's going to jump up, but at some point it will start to increase again. Even if we go way back in time, you can see we bottomed out 2005 and then skyrocketed up till 2009, worked way through that inventory. And it's very interesting because we bottomed out in 2018 and went up all the way to 2020. And then we fell off, the cliff again. We're bottoming out. Where do we go up? And this applies to the market as a whole. If you want to get rid of seasonalities, again, let's go, let me eliminate the area. I'm just going to do all again. So if we do all of MLS and we get rid of, as we look at some of these things and get rid of seasonality, it's like we still have an upward trend on prices. But again, if you go look what's happened the last few months, it's fairly flat. And I think we are kind of starting to peak out. And if we zoom in a little bit, we are going to peak out and flatten out on the price as well. Let's look at months of supply, right? So again, like I was saying, back in the recession, this is all MLS. We had 16 months of inventory. That's what downtown Charleston looked like on inventory in 2019, right? So that's why there was a big time lag on price increases. Is you cannot be going up on price when you have 16 months of inventory. There's way too much supply and not enough demand. I also want to put in perspective of our 12-month average right now is 1.2, right? And even if we go back to monthly, we're at 1.9, right? And again, for everybody who lived through this market, we had 17 months of inventory. So we were 10 times slower in the recession than we are today. So again, we are still in a healthy market on supply and demand. We are just fighting an affordability issue. It's not a supply, it's not an oversupply of houses. It's basically an affordability issue that has created pretty much like at the same time an undersupply of sellers willing to sell and buyers who cannot afford the house. So, we are fighting this affordability issue and not what we were back here in the recession.
Right.
So, and I know I've said this on here before, but back here, I was carrying, in 2009, I was carrying 55 listings myself. Right? So one person, I was carrying 55 listings myself. And that was because at this ratio, 3 of them would sell that month. So you had 52 sellers who didn't sell that month, and you had 3 who were successful. That was my life back here. So again, we are not in this same recessionary period. We have to find solutions for our buyers to make the houses more affordable, and at the same time to make sure that our sellers understand selling their house, what it does for them, whether they're going to rent, whether they're buying another house, downsizing, upsizing, what are they doing? You have to solve that affordability problem for both sides of your clients right now. And that's where to focus your time on is not the supply problem, it is an affordability problem. Homes for sale, we had 12,000 homes for sale back here. We're at 3,200. I'll take 3,200. That's not, especially think about it, there's 50% more people living here today than back here. and we have 25% of the inventory. So again, that's not a supply problem. You know, and again, it's just the next 12 months, it's like, how do you be smart about having conversations with your buyers and your sellers and solving different problems that we have not had to solve? You know, I mean, I've been doing this 21 years. We've never been in a situation where we've had rates go from 3% to 7%. And it's learning to have conversations, getting your mortgage brokers involved. It's solving those problems in a different way. So again, I don't see where we're going to go. You know, you can see this peak kind of forming, and yes, we'll go up from here. Maybe we'll return to this level here, but I don't think we're going here. You know, this was done by 5 people buying a house at the same time, all speculative, and the builders building as much as they possibly could. Those people that are in the higher level positions with builders these days, they live through this, right? They're not going to repeat this error. Mortgage lending is not repeating the error. So we are in a different place. So anybody who says we're in this recessionary period, it's a completely different animal. We have some challenges, but it's learning how, you know, again, nobody's done this. It's learning how to have those conversations and making sure, you know, your clients understand what their options are. So does anybody have any questions, comments, input?
I got in late, but one of the things I saw today was talking about assumable loans.
So, and again, here's the challenges there is that there were not many loans that I am aware of that were assumable. And the ones that were assumable or that are still assumable, they're only assumable for the mortgage balance that's on it. And so, you know, you could have somebody who bought a house 10 years ago and they paid it down and they only owe 200,000. Well, now the house is 700,000. Well, that buyer can only borrow, if it is assumable, what is on that balance.
Okay.
So, I mean, in my 21 years, I've never had a loan assumed. And I don't know if anybody on this call has, but I just don't think that is, you know, a solution that is out there because of the way that the loans were written and structured. I don't think most loans are written up front to be assumable. I mean, even if your buyer has great credit and assets and income and all that, I think most loans are not assumable. You know, where interest rates go, I mean, if I knew the answer to it, I probably wouldn't be sitting here. You know, yeah, the Fed raised rates 3/4 of a point again this week. They're probably going to raise it again in December. You know, the Fed chair basically made it sound like they're going to try to probably have to keep rates higher longer than what they originally planned. So where are we at with rates a year from now? I mean, your guess is as good as mine. You know, at some point, the Fed is basically trying to break something to slow down inflation. And I mean, I don't know who, you know, when I go to the grocery store, I mean, the 8 to 10% I kind of laugh at because when you really do it on a percentage basis, the daily stuff that you get is way more than 8 to 10%.
Mhm.
You know, I don't, sometimes it feels like 8% every time you go. So again, they've got to control that inflation at some point, and they're not going to let up on those rates until they see, and I think as soon as they have confidence that there's a downward trend, I think you're going to start to see them peel back a little bit. But it's such an unusual position to have hyper low unemployment, really high inflation, you know, and now we have high mortgage rates. You know, you got high rental prices. It's a position that I don't think anybody has a clear answer on what the future looks like. But I think for the foreseeable future, we have to learn how to sell houses at 7% or higher. You know, and again, when rates and rates at some point will come down. When they come down, then you could have another refinance boom of the people who were purchasing. You could have an increase in buyer demand because now it's becoming their affordable price point. Prices are probably best case kind of going sideways for a while because you can't think prices are going up when rates are 7%. It's a matter of finding a stabilization because we're going through a phase right now of that high inflation. And I don't know, like the unemployment doesn't seem to be changing at all. Just look around, help wanted signs, everything's out there. So I think that we are in this path for a little while now of the high interest rates, and you just have to figure it out. We all have to figure out how to sell houses at 7%. There's not wait until it goes back down to 3% because that's probably not happening. So there's somebody on the chat here.
Jeremy.
Jeremy, thanks for sharing that. Jeremy, do you have any experience with that?
No, but over the summer I sat in on a lunch and learn
Okay.
with the Kiernan team, and they did a whole afternoon talking about assumable mortgages and things like that. I have not experienced one personally, but this is a pretty good overview.
In 21 years, I have not heard of a single agent who has told me about an assumable mortgage closing. So again, I'm just questioning how many mortgages are written with that clause in there that you can actually assume a mortgage. And the bigger problem is with the 30 to 40% increase in home prices, that assumable mortgage, there's a high likelihood that's probably less than what your buyer needs to borrow. Maybe for the next call, if I talk to somebody that has done one, I'll figure out the details to it. But I think there are so few examples of that. Jan, have you ever heard of one?
I heard of them back in the 80s, in the late 80s, when people had were taking out 18%, and they could assume something at 12 or 14%. Then, and what I remember about it is that it had to be written in to the loan document that it could be assumable.
Yeah.
And I'm not sure how many of the loan documents recently are going to be allowed to be assumable at any price because they were so cheap. The banks are probably not going to be excited about it.
I think if you look at a majority of the refinances or loans that have happened the past 10 years, I would say a very, very small percentage of those would be assumable.
Yeah. And you also have to be able to make up the difference.
Correct. And that's I think in the end, it's going to be less than what your buyer needs to borrow, even if it is assumable. So, well, let's learn something new this month and talk about it next month. But just, we're all going to be fine and we're going to figure this out, but you really need to focus on the trigger points to have conversations with your people in this current environment. And you can't wait for it to change because it doesn't look like it's going to change quickly. So we got to figure out those conversations to have to sell houses in this environment.
I have a question for Jeremy. Did Kernan say that they were doing assumable mortgages? Do you recall if he said that?
No, he will hold events and talk to things that are starting to trend like online and people talking about them on social media and stuff like that. And a lot of the time it's like the bright, shiny thing that everybody wants to jump on. And he kind of like brings a level of reality to it. With a 30-year conventional mortgage, you typically can't do it. I believe there are different rules, if recollection serves me, with VA loans, if it's veteran to veteran.
Okay.
But the video goes into a little more depth. This is prompting me to rewatch it again.
I just want to know.
Well, I'm glad you said that because it did mention VA and FHA. And VA, they would have to be a veteran as well. And then I don't know why they specifically mentioned FHA as assumable, but they did.
And I think make sure before you go down this path with a buyer, you know, you see the mortgage on the existing one that says it's assumable, but also clearly understand what they can borrow, because it is not going to be 100% of what that house is worth today.
Correct.
Mhm.
I know when I bought my first house in the late 80s, mortgages were assumable at that point, just like Jan said. But then they went away in the 90s because I bought like 5 years later. For that reason, that why would lenders make something assumable as rates came down?
Yep.
So just be curious to know. That's interesting about FHA and VA though.
Well, thanks for everybody's input today. And everybody have a good month out there. I know we have some
Anton?
holidays ahead of us, but doesn't mean houses aren't being sold. So
I have a
we'll-
question.
Yes.
I'm sorry. Hi, Anton.
Hi.
This is Taria. The 2-in-1 buy down, I've heard a lot about that. Is that something that you have experience with? And from the listing side, are sellers willing to provide the money for that?
So here's the way the 2-1 buy downs work, is that you have a lot of builders right now within their own internal mortgage companies that are offering that. And it's like a teaser rate. So the 2-1 buy down, you get a lower rate the first year, middle rate the second year, and years 3 through 30 are at what the market would deem a normal rate. So I mean, you might be, and I'm just throwing out numbers, you might be at like 5.25 for the first year, you might be at 6.25 the second year, and then you're at 7, you know, the rest of the time. So it's a lower payment for the first couple of years, but then it's going to be at your normal rate. You can have, any lender can offer that. It's cost up front. So does your seller offer that on the listing? And, you know, it could be $10,000 or $15,000 or $20,000, depending on the price of the house. But it's like offering closing costs. You're just offering a rate buy down incentive. So get with your preferred lender, and they can put together for your listing or for your buyer, here's what a 2-1 buy down looks, and here's how much it costs. The banks are making their money, okay? So I want to make sure that clear. The banks are making their money. They're making the money they're sacrificing for the first and second year interest payment at closing. So the banks love it, right? They're making their money the first day of closing rather than in the first 2 years in interest. Right? So don't think the banks are doing you a favor. They're offering you this program, but they are making their money. But it could make the difference between a buyer who's comfortable with moving forward and maybe one who is not. So I'm not saying not to investigate it. Just realize the bank is making their money in some form or fashion.
Thank you.
So, all right. Well, everybody have a great weekend. And we'll do this again next month. And any input is always welcome. So don't hesitate to say anything. So, all right.
Right. Thanks,
care.
Anton.
Thanks,
Appreciate it.
Anton.
Yep.
Thank you.